Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. The number one wealth killer we want to avoid at all costs. The desire to get rich quickly. The desire to make money quickly. The desire to become an overnight millionaire. We as human beings are not very patient. We want everything now. Actually, most of us wanted things yesterday if we could help it. We can't wait 10 seconds for the traffic light to turn green. We can't wait 60 seconds for the microwave to finish heating up our lunch. And we definitely can't wait 10 years for our investments to compound. We want our income to double by the end of the month, and we want our stock portfolio to quadruple by the end of the year. However, this desire to get rich quickly is one of the worst wealth killers of all because it makes us do some stupid things when it comes to wealth building. We go after get rich quick schemes that promise 100% return on our investments instantly. We get greedy and invest our money in products that we don't understand. And we take unnecessarily oversized risks, borrowing and over-leveraging with the hopes that we can strike it rich. We essentially forget the true fundamentals of personal finance. Living below our means, staying out of debt, and saving and investing a good chunk of our income in low-cost, broad market index funds over a long period of time. The proven path to wealth building. So be careful of the desire to get rich quickly. Don't forget the fundamentals if you want to truly build lasting, sustainable wealth. The biggest thing about making money is time. You don't have to be particularly smart. You just have to be patient. The number two worst wealth killers we want to avoid at all costs. Luxury cars. Yes, I know, this is a controversial one, especially if you love cars and luxury cars at that. However, luxury cars are not cheap. And if you get in the habit of driving them early in your career, you're really hindering your ability to grow your wealth. At the time of this video, the average price for a so-called luxury car is approximately $75,000. Think brands like Audi, BMW, and Mercedes-Benz. And $75,000 just gets you in the door. You add all the bells and whistles, sunroof, air sensing wipers, heated seats, remote start and side impact bags, you're looking at something closer to $100,000 or more. When you finance a $100,000 car, you're looking at an average monthly car payment of $1,500 to $2,000 depending on the loan term. That is the price of housing in many places. And we're not even factoring in ongoing costs like insurance, gas, or maintenance. If you're needing to shell out $2,000 per month on a car payment every single month, that is precious money that's not being invested and growing your wealth. So forget the status symbol that supposedly comes with a luxury car. We might think that we're so cool driving our luxury cars and that everyone is impressed by us. But do you want to know the harsh truth? No one cares. How do I know this? Because I was that idiot that I thought I was the coolest guy on the street. In my mid-20s, when I was making basically minimum wage, I purchased a brand new Volvo S40 thinking that it made me look successful. The irony was that I was nowhere near being successful. I was broke and should have been taking public transportation or biking to work. All the car payments I made paying off that car disappeared into the bank's bottom line, and I was left with a car worth 20% its original price 5 years after the purchase. Bottom line, don't kill your wealth like I did. In talking about wealth killers, do you know what else can make our lives miserable? When our personal information is not well protected online. How often does this happen to you? You're in the middle of an important meeting or spending quality time with the family, and you're interrupted by a phone call or a text from a number you don't recognize. Most often, a scam call. If you're like me, more often than you like, right? And one of the key reasons why we get so many spam texts and calls is because big companies can't keep our data safe. Recently, AT&T revealed that nearly all of their customers' call and text records have been exposed in a massive data breach. And it hasn't even been a few months since they admitted over 70 million of their users' social security numbers ended up in the dark web. The stolen logs also contain a record of every number AT&T customers called or texted. So even if you don't use AT&T, if someone who texted you did, then your number has been exposed. So what can you do to protect yourself? Which is why I'm excited to talk to you about Aura, the sponsor of today's video. Aura will alert me if they find my phone number or any other sensitive information has been compromised. And they give me fast fraud alerts if anyone tries to use that data to access my credit or bank accounts. Aura does so much more to keep me and my family safe too. I also get things like identity and credit monitoring, credit lock, password management, antivirus protection, and even VPN. I personally use this VPN service on a daily basis, and I get all this at one affordable price. I can also get their AI-powered call assistant that will pick up unknown calls on my behalf to screen them for spam or scams. The AI forwards legitimate calls to me so I don't miss appointments, deliveries, and emergencies. And it protects me from harmful text messages by filtering out known spam numbers and scanning links in the message for phishing threats. I'm not leaving myself and my family vulnerable to data breaches, and if you don't want to either, you can go to my link aro.com/financialtortoise and try your first 2 weeks for free. That's right, it doesn't cost anything to test out this powerful tool. I'll also have a link in the description below. Alright, with that said, let's go back to the video. The number 3 worst wealth killer we want to avoid at all costs. Buying a house too early, and most often a house too big. This is one of the worst wealth killers because it's so hard to unwind ourselves from. While buying a luxury car too early in our career is not a wise move, once we recognize this negative impact on our finances, we can pretty quickly unload it via the used car market. A house, not so easy. Depending on the housing market, our house can sit on the market for months or years, draining precious dollars out of our pocket. So then why do so many people get themselves in this pickle? This is why. Homes symbolize success like nothing else. You might have a fancy job at a fancy company, but most people wouldn't think you have money until you show them your fancy home. Thus, you go out and get the biggest home you can find. Your realtor shows you the nicest home in his portfolio to whet your appetite. Your banker tells you how much you can borrow against that home. Almost the full asking price. And your friends tell you about their brand new big home that they just bought. And so you think, why not, right? You work hard and your income is on the rise. You need a home befitting your income and your social status. But be very careful when it comes to home purchase. A right home at the right price can help appreciate your wealth. But a wrong home at the wrong time can kill your wealth. For example, let's consider a home that requires a $1 million mortgage. Not a crazy number if you live on the coast. And if you already have millions in net assets, not a crazy purchase either. However, if you're just starting out in your career, a $1 million mortgage could devastate your ability to build wealth. A monthly payment on a $1 million loan, 30-year fixed at 8%, is about $7,300. And we're not even counting all the additional housing costs, utility, property tax, home insurance, etc. These costs add up to approximately $10,000 in monthly housing costs. When you need to pay close to $10,000 in housing each month, as you can imagine, it's really hard to build wealth. Even if you're making a really good salary of over $200,000 or $300,000 a year, close to half of your salary is going to fund your housing cost. This is a situation where it's really hard to build wealth. Bottom line, be careful when it comes to your house purchase, especially a house that is too big, too early in your career. The number 4 worst wealth killer we want to avoid at all costs. Ridiculous investment expenses. This is one of the most significant drag on most people's investment returns. The direct impact and cost of the financial services industry. I've seen a lot of people's investment portfolios, and it's not uncommon to see people paying 1%, 2%, or sometimes even 3% of their assets to fund and investment managers. And on surface, 1, 2, or 3% doesn't sound like much. We pay close to 10% in sales tax and 20% in tip. So 2%? Nothing, right? But what we're not seeing with these 1, 2, or 3% investment expenses is that they compound over time just as our investment compound. Just that these expenses are working against us rather than for us. An extra 1 or 2% can cost investors thousands, if not tens of thousands over the lifetime of the investment. So how can we avoid this wealth killer? The most obvious way is to reduce the expense ratio we're paying for our investments. Let's say that you have a sizable investment portfolio, around $1 million, and you've been paying 2% expense ratio. That's $20,000 annually because it's being managed by a fund manager. In my book, this is way too much. If you're an average Joe like me who doesn't require a fancy investment strategy, I say fire your fund manager and learn to be your own financial advisor. For example, my personal favorite index fund is the Vanguard Total Stock Market Index Fund, VTSAX, and has an expense ratio of 0.04%. When I invest $1 million with VTSAX, I'm paying $400 in expenses annually. Now compare that with $20,000 you were paying earlier. Just by taking charge of your money, you're saving $19,600 a year. And this money will compound over the years, multiplying your wealth instead of fattening your fund manager's pocket. The number 5 worst wealth killer we want to avoid at all costs. In line with ridiculous and unnecessary investment expenses, ridiculous and unnecessary fancy investments. 400 apartment unit syndication deal that promises 4 times return in 2 years. A new crypto coin all the cool personal finance YouTubers are talking about. The new tech startup company that is scheduled to go public in a couple of weeks. If you're a smart individual, I know you're tempted by all these cool sounding, sexy investments. I mean, people are talking about them all the time. You see ads about them everywhere. And they all promise great future potential. So what can go wrong, right? But things can go wrong. And they can go wrong real quick and real bad. Most often when someone promises outside returns, this is a warning sign. We have no idea how well a new real estate investment will do in the future, especially in an untested market. We have no idea how well customers will respond to the new company. We have no idea how the economy will perform later this year. There is so much that we don't know. So be very careful where you invest your money. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. The number 6 worst wealth killer we want to avoid at all costs. Not investing. Alright, so you've been burned by so-called sexy investments. So it's easy to be scared of investing in general. You lost all your money in that new tech startup your friend convinced you to invest in. Your real estate syndication deal is barely holding on because a high interest rate is eating into all of its profit. Your crypto coin? People are making memes and poking fun at individuals who actually bought them. So now you swing the other way, to the other extreme. You consider all investments a scam and you vow never to fall for them again. You say investing is a fool's errand. So you remember your grandpa's words and believe the best place to park your money is in a good old savings account. Or when you feel a bit dangerous, a high interest CD. However, when you avoid investing in the market, you're really holding yourself back from achieving your full wealth potential. You're killing your opportunity to grow your wealth because regardless of how high of an interest rate your savings account or your CD provides, it will never be enough to really grow your net worth. They'll be just enough to keep up with inflation, if that. But that is the cap. And you will always be relying upon your work to fund your lifestyle because you don't have any appreciating assets. So you do want to invest if you truly want to build wealth. The key is recognizing what to invest in. Not in risky, untested, sexy sounding investments, but in tried and true, low cost, well diversified investments. The Vanguard Total Stock Market Index Fund, aka VTSIX, that I talked about earlier, is a great example of this. This one fund is not only very affordable, but it represents all the publicly traded companies in the US stock market, approximately 4,000 companies currently. Across history, the US stock market has had an average annual return of 10% per year. I know, it doesn't sound sexy, amazing, or out of this world. However, when you can compound this 10% year after year for decades, this simple strategy of investing in the market can one day turn you into a millionaire or a multimillionaire. The winning formula for success in investing is owning the entire stock market through an index fund and then doing nothing. Just stay the course. A quick reminder before we move on to the next wealth killer. Make sure to download your free one-page companion PDF guide that goes along with this video. Everything I'm covering here in a simple to digest one-page format. So go to the link I'll have in the description below to grab your free copy. The number 7 worst wealth killer we want to avoid at all costs. Taxes. Now, there is no way we can avoid all taxes. Paying taxes is a natural part of making money and living in the United States as well as most countries around the world. We have sales tax when we buy things. We have property tax if we own a home. Social Security and Medicare tax to fund our safety net. And we have the dreaded income tax, which could take 20 to 30% of our hard-earned money. Money that if we're strategic and smart could remain in our pocket, being invested and growing our net worth. So what we want to do is always think of ways to legally minimize our tax burden. Anyone may arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the treasury. There is not even a patriotic duty to increase one's taxes. And for average individuals like you and I, one of the best and simplest ways to reduce this tax burden is to invest in tax-advantaged retirement accounts, such as the 401k, Roth IRA, Defined Benefits Plan, and Health Savings Account, aka HSA. When you invest in these accounts, your money is sheltered from tax. With a traditional 401k, you make contributions with pre-tax dollars, so you get a tax break upfront, helping to lower your current income tax bill. Your money, both contributions and potential earnings, grow tax-deferred until you withdraw it. With a Roth IRA, though you pay taxes upfront, all the money investment grows tax-free, and withdrawals are tax-free in retirement. If you want to learn more about how you can save money in taxes, I have a link to my tax playlist in the description below. The number 9 worst wealth killer we want to avoid at all costs. Interest. Specifically, interest on debt. Compounding is one of the most powerful principles in the world of investing. A small amount, compounded over a long period of time, can have the ability to become millions. However, just as it can grow our net worth, it can just as powerfully work against us. When we're paying interest on debt we owe, our money is compounding for somebody else, our creditors. Imagine a credit card debt of $20,000 with an interest rate of 15%. If we were to only pay the minimum on this credit card, at a 2% minimum payment percentage, it would take us 47 years to completely pay off that credit card debt. However, what is worse is the total interest you would have paid to the credit card company. $33,000. On an original debt of $20,000, we're giving the credit card company the gift of compound interest in the form of $33,000 extra dollars. Don't let debt and interest on debt kill your wealth. No matter what anyone says, it is ridiculously hard to build wealth when you have debt and you have compound interest working against you. Pay off high interest debt as quickly as possible so you can leverage the power of compounding to work for you, not against you. The number 9 worst wealth killer we want to avoid at all costs. Expensive friends. We all have them. The party starts when they arrive. They know just the right restaurant to go to for your 40th birthday. They're going to Paris next week, and you'd be crazy to miss out on this once-in-a-lifetime trip. Yes, they can be fun, and they're likely great people. However, be wary of how they can impact your wealth. Expensive friends can be, if bluntly said, expensive to keep up with. They might be in a completely different financial situation from you, super high income, inherited wealth, or just price insensitive because they suck with money. No matter if their financial habits are impacting your ability to save and invest for the future, they are wealth killers. And if we know who they are, actively try to limit the amount of money and time we spend with them. Or if you want a complete change, it might be time to get some new, frugal friends. The number 10 worst wealth killer we want to avoid at all costs. Expensive hobbies. Hobbies are great. We all need them to inject some fun in our lives, and they in itself pose no problem. The problem is what type of hobbies we decide to pursue. If you find yourself gravitating towards expensive hobbies like collecting rare watches, auto racing, or flying private jets, and you struggle to comfortably fund them, this could be a problem. Not only are they taking precious money out of your pocket, they could socialize you into spending more money. I know of friends who love collecting watches, and they can't help themselves from spending every extra dollar they have in buying more watches, especially after having been exposed to someone who owned a nicer watch collection. My personal take? There are a lot of fun things to do in this world that are not as expensive. It doesn't cost much to go walking around your neighborhood, to get a cup of coffee with a friend, or if you're a nerd like me, reading. A good book costs no more than $20, and a digital Kindle version is most often way cheaper. Bottom line, be careful not to let expensive hobbies drain a good chunk of your hard-earned income and kill your future wealth. Thank you guys for watching. In the line of bad money decisions, if you want to learn some of the worst ways to get rich, please check out my video here. Until next time, all the best.